Looking at a long-term notes payable, we have on January 1st, 2019, Johnson Corp issued 2-year note due December 31st, 2020 with a face value of $10,000, receiving $7,694.68 in exchange. Prepare the journal entries to account for the note on the date the note is issued, at the end of 2019, and at the end of 2020. So we can go ahead and start with the date it was issued, January 1st, 2019, and obviously we're receiving cash in exchange for a liability of notes payable, and there's also a discount on the notes payable because of that receiving $7,694, but the payable actually being $10,000. So we'll just type in the cash of $7,694.68, the note payable of $10,000, and then we can calculate the difference. To see that we have a discount of $2,305.32. And before we calculate the interest expense, we need to figure out what the rate is for this situation. And so we could use the present value tables and then solve for the factor and then find that factor that aligns to the 2-year period. But we could also just do it in Excel using the rate function. So we can type equals rate, open parentheses, number of periods is 2 years. There are no payments that are being made throughout the course of that 2 years, so we'll put 0 there. Then it's asking for the present value, which is the $7,694.68, and the future value is the $10,000, but we need to put that as a negative $10,000 because that's the payment that we'll make. Close parentheses, and we'll get 14%. And I'm just going to quickly show you, if you didn't put that negative there indicating it was our payment, it gives you a error, numerical error. And so if you get that error, you probably made a mistake in inputting your information somewhere in that rate function. So now we have the 14%, and we know that that's our rate, and so we can use that to calculate the interest expense at December 31st. So December 31st, 2019, we're going to have our interest expense, and we're going to credit our discount on the notes payable. And this is going to be equal to our $7,694.68 times 14%, and it's once a year, so we don't need to do the like a half or anything because it's not semi-annual payment. So we could say times 1 since it's 1 year, and we get $1,077.25. And so we took care of 2019, and then December 31st, 2020. And in this entry, we're recognizing the interest expense and dealing with the payment on this notes payable, or the elimination of the notes payable. So we'll have here notes payable for the full $10,000. We'll have our interest expense, which we'll calculate in just 1 second, our discount on the notes payable, and cash. And so cash is going to align with this $10,000, and now we just need to calculate this interest expense and the discount on the notes payable. And so we can do that by saying equals the $7,694.68 plus this $1,077.25, close parentheses, times our 14%, technically we would say times 1, and we get $1228.07. And then we could confirm that equals our discount, our total discount, by adding the two interest expenses together, and that should equal our discount on the notes premium, and it does. So of course, if you didn't want to bother doing like the long math, you could have just said the original discount minus this credit to the discount to get the difference. But of course, if you were doing multiple years, it would be wiser to use the original cash price and then add what we've amortized so far.